Good morning, everybody. My name's Herman Nieuwoudt. I'm a partner with PKF here in Alberton, Johannesburg. With me, I've got Jazan, who's one of our senior managers on our external audit side. And I thought it would be a good idea today to talk about something that's relevant to most corporations, other than getting a clean external audit report, is the cost of your external audit. So we're going to have a brief discussion about some ideas about what you can do as an auditee in order to make your audit more efficient, to get a better product from your external auditor, and also to save some money around it.
So Herman, what drives the cost of an external audit?
In simple terms, it's time spent. As professional service providers, your external auditor basically needs to be remunerated for the time that they spend. So in short, you'll have various levels of staff with various levels of experience and technical knowledge, and based on that, an hourly rate would be attached to that individual, and that would ultimately drive the overall cost of your external audit.
And what factors would help the process for audit, from an audit perspective, more efficient from our side?
I would say that there's two main areas. I'll go a little bit into some of the categories that you can zoom in on, but firstly, it depends on how prepared I am for my external auditor in order to start my audit. In other words, the information gathering. So presenting information in a format so that the external auditor can spend or be as efficient as possible in analyzing that information. And aside from the information gathering specifically for your external audit, I would say the second component is how good is your company at storing and managing information about the transactions that occur during the period that your external auditor is reviewing. I've got a few bullet points that I'll generally discuss. The first one is in terms of schedules on balances agreeing to your annual financial statements. Your annual financial statements are unique to the extent that your management accounts during the period don't have all the components that you typically have in a pack of, or IFRS for SME, or any other accounting framework set of financial statements. So when you prepare for your external audit, it is worthwhile going through those disclosures in your statutory financial statements, your big pack of financial statements, and making sure that you have on hand and available schedules and supporting documentation to support every single item. For argument's sake, your debtors and your creditors, that's disclosed in your financial statements on your statement of financial position. When your auditor starts the project, it saves them quite a bit of time if you already have a reconciliation between your debtors age analysis and any other accruals or any other short-term receivables that you may have, with a reference to where that information is available. The second item that I've got is jumping to the second point that I made, and that's a storage of your source documents during the period. The more concise and the more accessible your system is of storing your documentation during the period, which includes your own invoices, your delivery notes, information from your suppliers, statements from suppliers, bank statements, anything that you use in order to put together your financial information. The more concise and the more accessible and the more logical you store that information and have it accessible, the easier it is for you and also for your auditor to access that information. Third item that I've got is supporting documentation for specialized transactions. Now, these often create quite a bit of backlog, or shall I rather say a lot of time could be spent by the external auditors to unravel, understand, and then to interpret any transactions which are unusual. An example of that is a corporate action. So in other words, if you, for instance, acquired the shares of another private company in South Africa, or for that matter, any other significant asset, these types of transactions normally have supporting documentation in terms of contracts that might underlie them, and you may even have the work of a specialist, a lawyer, or some kind of technical specialist who advise you on the transaction. Have this information available, and if you want to go one step further, link this information to your disclosure in your financial statements to make it easier for your auditor to immediately zoom in on the topical issues and thus spending less time on that. The next bullet point I've got is reconciling your corporate taxes and your balances to transaction totals on the financial statements. It is a risk to your external auditor to ensure that your tax declarations was done, but also to make sure those numbers are accurate. And there's a bit of work that your external auditor will do in order to pull together your corporate taxes, whether it's normal corporate taxes, whether it's maybe a dividend tax that was paid, it could be a royalty tax or withholding tax, or also taxes like VAT. Your auditor would want to investigate whether those declarations were done correct and whether those taxes were calculated correctly. If you have information on hand tying back to your annual financial statements, that saves the auditor quite a bit of time in order to make sure that those balances and transaction totals are accurate. Next bullet point I've got is quite topical at the moment, and it's something that I think is becoming more and more prevalent in terms of ensuring that this information is correct, and that's your cash flow statement that you disclose on your annual financial statements. Your cash flow statement is a reflection of exactly that. It's the rands that go in and out of your bank account, and possibly your petty cash as well, if you have a system where you have significant cash in your business. But the short of it is, your cash flow statement should only disclose the actual rands, or whatever the currency is that you report in, that actually went in and out of your cash transactions or your bank account for the period. And what quite often happens due to the nature of how we calculate those cash flow statements is we end up with transactions which were non-cash transactions. And those transactions need to be eliminated from the face of your cash flow statement. A typical example is interest. Interest could either be interest that is paid actually on, for instance, a lease that you paid to the bank, that those rands went out of your bank account and into the bank's bank account, which is a cash outflow. But it could be that you charge interest on a loan account, or you charge an employee interest, and those are not necessarily cash transactions. If you prepare proper workings and you eliminate those non-cash transactions from your cash flow statements and able to reference it back to your accounting record, it does save your external auditor quite a bit of time in ensuring that the cash flow statement is accurate. I have a few examples here of disclosures which typically create challenges in the finalization stage of an audit. Now, in terms of depending on what your accounting framework is, whether it's IFRS or IFRS for SME, or maybe some other type of framework, depending on the legal nature of your entity, there are certain disclosures that are required in your annual financial statements which you typically don't need and you don't really zoom in on when you do report your internal reporting during a financial period. And things like these are the disclosures on your director's remuneration. You may have leases, and depending whether you're on IFRS for SME or full IFRS, there are various rules and various disclosure requirements around leases. The same for financial instruments. They may be very simple or they may be very complex, but all accounting frameworks have very specific disclosure requirements around that. And the last one I have, which is quite often missed, is disclosing your guarantees and your securities in your financial statements with regards to borrowings, or maybe where you make resources available to other users or to other entity. I'm going to pause here in terms of the detail of what would make it easier for your external auditor to spend less time, and I'm going to close off by saying that more work done by you on the front end of your audit will definitely save money and have a less frustrating process during the external audit process. Going into that, I would propose that you enter into a negotiation with your external auditor. Your external auditor is also under pressure in order to ensure that they deliver the correct quality to you. So there are simply certain things that your external auditor does need to do. However, if you as an auditee up front become very proactive, and on some of these things that I've mentioned now, make sure that you present information in a meaningful and easily accessible way, you will save your external auditor time. And on the back end of that, negotiate. So if you are efficient in providing that information, negotiate with your external auditor of how we can maybe look at tweaking those budgets in terms of their estimated time that they would need to conduct the audit, because of the way that you've been proactive. And that's it. We at PKF love building long-term relationships with our clients. So please contact us if you need any support from an external point of view, an internal point of view, or any other consulting services. We'd love to make contact with you. And even if you just have a general inquiry, whether you use us as a service provider or not, please make use of it. All of our information is available on our website, pkfvga.com.